Welcome to Money Mindset Hub, the place where we empower you to take control of your financial future. I'm your host, Raul Sofa. Let me ask you something. Have you ever looked at your savings account and thought, is this all there is? Is my money just sitting there? Or perhaps you've heard stories of people building incredible wealth and wondered, how did they do that? Could I ever do something similar? If so, you're in the right place. Today we're tackling a question that's on the minds of many, especially those just starting their financial journey. How do I invest in stocks? Or even more broadly, how do I even begin to invest? It might seem like a towering mountain to climb, filled with jargon, risk, and complexity. But what if I told you that the core principles of investing are accessible to everyone? What if I told you that with the right mindset and a little guidance, you could turn your hard-earned money into a powerful engine for growth? Consider this. Over the long term, the stock market has historically outperformed most other types of investments. We're not talking about get-rich-quick schemes, but a proven strategy for building wealth over time. The biggest regret many seasoned investors have, not starting sooner. So if you're ready to move from just saving to actively growing your wealth, stick around. We're about to demystify the world of stock investing step by step. Before we dive into the how, let's quickly cover the what. What exactly is a stock? Imagine a company, say your favorite coffee shop, a tech giant, or a car manufacturer. When you buy a stock or a share of that company, you're essentially buying a tiny piece of ownership in it. You become a shareholder. Think of it like owning a very, very small slice of a very large pizza. If the pizza place, the company, does well, makes more money, and grows, the value of your slice can increase. If it doesn't do so well, the value might decrease. Why do companies offer these slices to the public? Primarily to raise capital, money they can use to expand their business, develop new products, hire more people, or pay off debt. And for you, the investor, it's an opportunity to participate in their success. So when you hear people talking about investing in the market, they're often referring to buying these shares of publicly traded companies. You're not just gambling on numbers on a screen, you're investing in the potential growth and profitability of real businesses. Okay, so we own a tiny piece of a company, but why should we bother? Why take our money out of a safe savings account and put it into something that, let's be honest, can go up and down? The primary reason for most people is wealth creation. Historically, as I mentioned, the stock market has provided returns that significantly outpace inflation. Inflation is that silent wealth killer that makes your saved cash worth less over time. If your money in the bank is earning 1% interest, but inflation is at 3%, you're actually losing purchasing power. Investing in stocks offers the potential to not only keep pace with inflation, but to grow your wealth substantially beyond it. Another key reason is achieving long-term financial goals. Are you dreaming of a comfortable retirement, buying a home, funding your children's education, or maybe even achieving financial independence sooner rather than later? Investing can be a powerful tool to help you reach these milestones. Relying solely on savings, especially with current interest rates, often isn't enough. Think about the power of compounding. This is where your investment earnings start generating their own earnings. It's like a snowball rolling downhill, getting bigger and bigger. The earlier you start, the more powerful compounding becomes. Albert Einstein reportedly called compound interest the eighth wonder of the world, and he was right. And finally, investing can also be about supporting businesses you believe in. While financial return is key, some investors also choose to invest in companies whose values align with their own, or whose products and services they think will make a positive impact. So it's about more than just numbers. It's about your future, your goals, and making your money work as hard for you as you work to earn it. All right, you're convinced. You see the potential. Now for the practical part, how do you actually do it? Let's break it down into manageable steps. Step 1. Define your financial goals and risk tolerance. This is crucial. Why are you investing? Is it for retirement in 30 years, a house deposit in 5 years? Knowing your timeline will significantly influence your investment strategy. Equally important is your risk tolerance. How comfortable are you with the idea that your investments might lose value in the short term? Generally, if you have a longer time horizon, you can afford to take on more risk for potentially higher rewards. If you need the money sooner or you're naturally more cautious, you might opt for lower risk investments. Be honest with yourself here. Step 2, educate yourself, but don't get overwhelmed. You're doing this right now by listening to this podcast. There's a wealth of information out there, books, reputable financial websites, courses. Start with the basics. Understand terms like diversification, ETFs, mutual funds, and dividends. A word of caution, there's also a lot of noise and bad advice, especially on social media. Stick to credible sources. We'll link some good starting resources in our show notes. The goal isn't to become a Wall Street guru overnight, but to understand the fundamentals so you can make informed decisions. Step 3, decide how you want to invest. There are several ways to invest in stocks, individual stocks. This means picking specific companies you believe will do well. It requires more research and carries higher risk if you don't diversify properly. For example, buying shares in Apple or Tesla. Exchange-traded funds, ETFs. These are like baskets of stocks. When you buy an ETF, you're buying a small piece of many different companies at once. For example, an S&P 500 ETF gives you exposure to 500 of the largest US companies. This is a great way to instantly diversify and is often recommended for beginners. Mutual funds. Similar to ETFs, mutual funds pool money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. They are often actively managed, meaning a fund manager makes decisions about what to buy and sell, which can sometimes mean higher fees. Robo-advisors. These are digital platforms that use algorithms to build and manage an investment portfolio for you based on your goals and risk tolerance. They usually offer low fees and are very beginner-friendly. For most beginners, ETFs or low-cost mutual funds or even a robo-advisor are excellent starting points due to their built-in diversification and simplicity. Step 4. Open an investment account, brokerage account. You can't just buy stocks directly from a company, usually. You'll need to open an account with a broker. Think of a broker as a middleman that facilitates your stock market transactions. There are many reputable online brokers available today offering low or even zero commission trading. Look for brokers that are regulated, have good customer service, offer educational resources, and have a user-friendly platform. Some popular names include Fidelity, Charles Schwab, Vanguard, Interactive Brokers, or, depending on your region, platforms like Wealthsimple in Canada or Robinhood in the US. Do your research to find one that fits your needs. The account opening process is usually straightforward and can be done online. Step 5. Fund your account and make your first investment. Once your account is open, you'll need to transfer money into it. Start with an amount you're comfortable with. You don't need a fortune to begin. Many brokers allow you to buy fractional shares, meaning you can buy a portion of a share if you can't afford a full one. Then it's time to make that first investment. If you've chosen an ETF, for example, you'll search for its ticker symbol, like VOO, for the Vanguard S&P 500 ETF. Decide how many shares or what dollar amount you want to invest and place your order. It might feel a bit daunting the first time, but it gets easier. Step 6. The long game, patience and consistency. This isn't a sprint, it's a marathon. Don't panic sell if the market dips. Don't constantly check your portfolio. Investing is about long-term growth. Consider dollar cost averaging investing a fixed amount of money at regular intervals, regardless of whether the market is up or down. This strategy can help reduce the impact of volatility and builds a disciplined investing habit. Now that we've covered the how-to, let's talk about the mindset needed for successful investing. This is where the Money Mindset Hub philosophy really comes into play. 1. Diversification is your best friend. Don't put all your eggs in one basket. Spreading your investments across different companies, industries, and even asset classes like bonds helps to reduce risk. If one investment performs poorly, others can help offset those losses. This is why ETFs and mutual funds are so popular for beginners. 2. Invest for the long term. The stock market will have ups and downs, that's normal. Trying to time the market, buying low and selling high consistently, is incredibly difficult, even for professionals. A far more reliable strategy is to invest in quality assets and hold them for the long term, allowing compound growth to work its magic. Think in terms of years, even decades, not days or weeks. 3. Keep learning but avoid emotional decisions. The financial world is always evolving. Stay curious, keep learning, but base your decisions on research and your long-term plan, not on fear or greed. Media hype or a hot tip from a friend can lead to poor choices. Stick to your strategy. 4. Understand costs. Fees can eat into your returns over time. Be aware of brokerage fees, fund management fees, expense ratios for ETFs and mutual funds, and any other costs associated with your investments. Opt for low-cost options where possible, especially for passive investments like index ETFs. 5. Rebalance. Periodically. Over time, as some investments grow faster than others, your portfolio's asset allocation can drift from your original target. Periodically, say once a year, review your portfolio and rebalance it by selling some of your outperforming assets and buying more of your underperforming ones to get back to your desired allocation. An anecdote I often share is about 2 friends. One, let's call her Sarah, started investing small amounts consistently in a diversified ETF in her early 20s. She didn't try to pick hot stocks, she just kept at it, rain or shine. The other, Ben, waited, trying to time the market, jumping in and out based on news headlines. Fast forward 20 years, Sarah's portfolio, fueled by consistent contributions and compounding, had grown significantly, providing her with substantial financial security. Ben, unfortunately, had missed out on major growth periods and made some costly emotional decisions. The lesson? Slow and steady often wins the race. So, there you have it, a beginner's guide to investing in stocks. We've covered what stocks are, why investing is so crucial for your financial future, the practical steps to get started, and the core principles for success. Is it a lot to take in? Maybe, but remember, every expert was once a beginner. The most important step is the first one. Key takeaways from today. Investing is about owning a piece of a business and participating in its growth. It's a powerful tool for long-term wealth creation and achieving your financial goals, helping you beat inflation and leverage the power of compounding. Getting started involves defining your goals, educating yourself, choosing an investment method. ETFs are great for beginners. Opening a brokerage account and investing consistently. Embrace a long-term mindset, diversify your investments, keep learning, manage costs, and avoid emotional decision-making. The journey of 1,000 miles begins with a single step. Your journey towards financial empowerment and growth through investing can begin today. Don't let fear or a feeling of overwhelm hold you back. Start small, stay consistent, and keep that money mindset focused on your long-term vision. Thank you for tuning in to Money Mindset Hub. I hope this episode has given you the clarity and confidence to start your investment journey. If you found this valuable, please like this episode, subscribe to Money Mindset Hub for more insights on personal finance and investing, and hit that notification bell so you don't miss our future episodes. We'd also love to hear from you. What are your biggest questions about investing? What topics would you like us to cover next? Leave a comment below or connect with us on our social media channels. Until next time, keep building that positive money mindset.